Right, what's good guys? Welcome to the module on what is essentially going to be the ultimate guide on prop firms. Not only are we going to get into why you should be going into prop firms, even if you may not be looking to trade other people's capital. I'm going to give you the math behind prop firms. I'm going to give you the exact strategy on how to pass a prop firm in a couple of weeks compared to a couple of months that most people take. And when you have questions like, oh, but what if I fail the challenge? Or like, I don't want my money to be, kind of like tied to other people. That's also going to be answered. And like, yeah, I'm going to get into the best prop firms. I'm going to get into what to look at when it comes to the prop firms, get into the differences between, one step, two step challenges, and all sorts of stuff. So yeah, this is essentially going to be kind of like the be all end all when it comes to prop firms. And yeah, let's get into it. Starting things off, I didn't actually put it inside the module, but just in case you needed to know what prop firms are, they're basically firms out there that kind of provide you with capital to trade with. And if you're able to make a profit on that capital, then you get to keep a percentage of that profit. Usually it's between 80% to 100% of the profits. And this does not mean that whatever capital they give you is like live money. It just means that, you have this amount, like let's say $100,000 in a demo account, and you trade that, and you basically only keep the profits that you make. Now with prop firms, the kind of like conventional way to acquire a account is to take a challenge. This challenge is essentially just like to put it in very, very simple terms, it's a little bit of an exam where you have a set amount of like a drawdown limit where you cannot lose a certain percentage. Usually that's anywhere between 3 to 10%. You also have a profit target that you need to hit, which is anywhere between 5 to maybe 15%. So as long as you can hit the profit target without hitting the stop loss target, then yeah, you're good and you will pass the challenge, and then you can start getting to the live trading phase, at which point whatever money that you make on top of the account that you already have, that's yours to keep. Now, this is different. Now, one of the things that you need to understand about prop firms is that this is a business, right? Later on, I'm going to get into like why it does not matter whatsoever if in the event that you fail an account. In fact, you kind of want to adopt the mindset of wanting to pass fast or fail fast. But for now, let's get into why you would, want to get into prop firms. So just to kick things off, this is like prop firms is something that allows you to trade with much more meaningful size than you otherwise could with your own, self capital. Essentially, like the majority of people who get into trading, they understand that trading is able to give them the lifestyle that they're looking for, or just the freedom, or just to, give them some options in their life. But the problem is that not everyone starts trading with $100,000 in their bank account. And that can be a problem because if you are, let's say, starting with $10,000, maybe 50K, now 50K, you can still make a pretty decent living, but still like anywhere under 50, that's when you get into a little bit more dangerous territory. Because in order, just to give you an idea, the trader, if you're able to make 10% a month over month, you can consider it pretty good, right? There are a lot of people out there with a lot of money that would be more than happy to park their money with you as a trader if you happen to be able to average 10% a month for, many years in a row. So 10% is amazing. The problem with having less than, let's say $50,000 of capital is that you may be amazing at trading. You may be world-class at trading, but the sole determining factor between you making basically $5,000 a month or $50,000 a month is not your trading skill. It's not your ability. It's purely the amount of capital that you have access to. And prop firms are amazing for this because for a small fee, you get to take a challenge and eventually end up with the equivalent of $50,000 to potentially $500,000 of capital to trade with. Now, I want you to picture this for a moment. If you happen to have $500,000 in funding, which is a lot more achievable than you think, then in the event that, you have a rough month, right? You make 2% on the month, that's 10K. And if you happen to have a solid month of 10%, that's 50K. And nothing's going to change when you have $500,000, right? In terms of the process, but the output is going to be about 100 times bigger, if that makes sense. And secondly, prop firms kind of remove the downside risk from your own capital, because even in the event that, let's say you have $100,000 to start with, you don't necessarily want to throw that all into a personal account. Why? Because you for example, if you happen to lose $10,000 from trading, you've lost $10,000. That is very different with a prop firm, because with a prop firm, a $100,000 account usually costs anywhere between, $100 on the low end. That's really, really low end. But, on average, you'd be expected to pay anywhere between, $200 to $300, maybe $500 for a $100,000 account. So in the event that you hit your drawdown limit, right? In the previous example, you have a 100K account, you lose 10%, you lose $10,000. That is your hard-earned money gone out the window, poof. When you lose 10% on a prop firm account, you don't lose $10,000. You lose whatever you ended up paying for the prop firm, which is a couple $100. Now, once you think of it that way, it becomes a lot more kind of like easy to stomach. Like the risk on paper is not actually that big, which I'm going to get into later with when it comes to prop firm math. But just Lastly, platforms are just a absolute no-brainer. Like if you're here in Blueprint or Bootcamp, or basically if as long as you're learning this AOC framework, it is something that works and it is something that gives you an edge. What is an edge? It just simply means like it's just trader speak for you make more money than you lose in trade over the long term over a large enough sample size. In the event that you are a trader that knows what you're doing, and if you have edge, which again, you're in the right place because chances are you are going to have an edge. The only determining factor between, again, you barely able to scrape by trading and potentially losing motivation because you're not making enough, between two, making an absolute killing on trading, being able to, travel full time, do all of these fancy shit, whatever, is the amount of capital that you have access to. And in this case, because the downside risk is capped at, a few $100s, while the upside potential is 10 times to 100 times of the amount that you're putting in. If you think about it this way, prop firms are almost like a, I don't want to really use this term, but it's kind of like a, hidden gem 100x meme coin, because it's kind of true, right? If you end up paying $200 for a 100K account, and over the course of 6 months, you get $20,000 worth of payouts, that is a 100x return. And the beautiful thing is, this is very much achievable. It's a lot more likely to happen than you catching some sort of hidden gem meme coin that goes 100x. And the best part is, like, this kind of amplifies what you're already doing, right? You're already spending the time and effort into trading. You're already spending, you're already grinding. Might as well get a much larger kind of output from trading, and prop firms are a great way to do that. So essentially, like, it doesn't matter if you are already good at trading, if you've been doing trading for a while, or if you're just starting out in trading, prop firms are just a great way to, like, it's just a no-brainer, right? It's a very low risk way to just diversify or just to acquire more capital. Over the years, I've had people ask me a lot, like, hey, if you've already been trading for so long and you have so much money inside your bank account, why are you still using prop firms? Well, because it's a no-brainer. Like, for very little downside risk, you get, a lot of potential upside. But yeah, regardless of who you are, as long as you're trading, you should definitely get into prop firms. It's just an absolute no-brainer, especially once I share with you later on how you can kind of like essentially use one account and trade like the equivalent of like 20 accounts, right? This is how the top guys do it. They're not trading, like, they may have like 20 to 40 or 50 prop firm accounts, but they're not trading every single one kind of like individually. There's an automation, there's a tool that allows you to sync everything together, and when you take a trade on one account, the rest copy. That is how you basically start trading with the equivalent of $1 million of capital within a couple of short months after starting your journey in trading. Prop firms make that possible. Like, yeah, just before we get into the the true nitty-gritty stuff, let's just talk real quick about the numbers and why prop firms make sense. And this is already kind of like, I've already prefaced this earlier by talking about, like, let's say hypothetically speaking, your goal is to get to $10,000 a month. Then, well, there are usually two ways that you can do this. One is, you have a self-capital where you are going to need just amazing months just to hit this target, right? Especially if you're starting with anything under than $100,000 worth of capital, which most of you watching this are probably not. And in this case, when you're running with your own self-capital, scaling, right? Now, the only way that you're going to achieve more capital is either you put more money yourself into the trading account, which, it also depends on you having an insanely, high income so that you can always have disposable income to throw into this, which again, most people do not. And secondly, you have to rely on compounding, which, involves you getting 10% a month for many months in a row so that your initial, let's say $10,000 can reach $100,000. Now, it's possible. At the same time, you're probably going to have many, many months where, even though you have on paper achieved an amazing return in a trading sense, in a strictly trading sense, but you're not getting that big of a reward from it. And so what's likely going to happen, and I've seen this happen many times, is that you're going to lose motivation. It's not going to be worthwhile, or you're just simply forced to do something else because you still, at the end of the day, you need to pay the bills. So prop firms make this possible. Instead of you needing months or years of compounding, you can achieve it in a couple of months, especially if you're here and you basically have the blueprint in order to achieve that. Now, compare this to a prop firm where a 100K account literally costs between anywhere, from $100 to $300. You do not need anywhere close to 10% gain a month. But let's say on paper, you only have one $100,000 account, 10% gain per month puts you to the 10K mark. Now, in the event that you have more, which chances are you're going to have more because there is absolutely no reason why you shouldn't have more. And in fact, I will give you the kind of like blueprint in order to scale your prop firm kind of like capital later as well. Then chances are you're probably going to end up with a couple of $100,000, or potentially $500,000, or potentially even $1 million. In that case, you need anywhere between 2 to 5% gain a month in order to sustain $10,000 months. Beautiful thing about that, 2% gain is literally one trade risking 1%. You get 2 R back. That's your target done for the month. in a single trade. So if you've ever seen, prop firm traders, they get like really complacent or they play it really, really safe. It's not that they suck at trading or they don't want to trade or they're not interested in trading. It's more of like they've already reached a point where the goal becomes less about kind of like scaling to the moon, but more about just capital preservation, because they already have the accounts, they already have the capital. All they need every single month is to get a couple of good trades in and boom, right? They're making anywhere between $40,000 to $50,000 a month. Now, they're not smarter than you. They just understand the math. And now you understand the math as well. And then lastly, again, just talking about self-capital and prop firms. Self-capital, of course, if you lose your money, you're losing your money. On prop firms, guess what? Your downside risk is capped. Whatever the amount is that you spent on the challenge. In fact, fun fact, most challenges even give you a refund on whatever you paid for the challenge once you pass it. So your downside risk is basically nil, minimal. Nada. And I know at this point you might be thinking, oh, there has to be some sort of catch here, right? Because, if prop firms keep doing this, like it's basically just free money for everyone. Like, wouldn't they go bankrupt? Are they running a charity? Are they money laundering? Well, no, I'm gonna get into that later. But just lastly, when it comes to prop firms, I'll share with you the scaling strategy later, but just understand that with prop firms, it's so easy to scale, right? Between you getting your first prop firm account at like $50,000, I've seen guys, in fact, we recently just had a guy who, in his first month, he acquired about $100,000 worth of capital. And 2 months later, he's now sitting at close to $500,000. In fact, I believe yesterday or the day before, he just shared that he got funded for another $200,000. So I think that squarely puts him at $500,000 worth of funding. And so at this point, like even if he only makes 2% a month, you do the math. So anyways, now that we have talked about the rough, kind of like introductory numbers when it comes to prop firms, let's actually get into what I like to call prop math, because this is usually a big thing that holds people back from just A, passing prop firm challenges, and B, this is something that holds a lot of people back from A, passing prop firm challenges, and B, actually making money from, their accounts once they pass the challenge and they're through to the live trading stage. So essentially, the way that I can boil it down is this. When you pay for a prop firm, right? Let's say you're going to pay $500 for a 100K account. And let's say in this case, hypothetically speaking, you have a drawdown limit of 10%, which is actually quite industry standard. So on paper, when you take a trade, and let's say you risk 1% on that trade, if you make 2R, you're going to see $2,000, right? That's fair enough. When you have a live account, you do in fact have $2,000. But when people see a red number in the four-figure, kind of like four-figure range, right? Because you're risking 1% on a 100K account, you're going to lose $1,000 in the event that you lose. Now, not everyone is immediately going to be kind of like used to or kind of like numb to just losing 4 figures in a day, because that's a decent chunk of money for anyone. So what you need to understand though is that just because the number looks big, you're not actually losing $1,000. In fact, you're losing much less, because if you break down the math, if you have a 10% drawdown and you paid $500 for it, every percentage that you risk is not $1,000, it's $50. And once you're able to break it down like that, it becomes so much easier for you to, risk the proper amount. Because so let's just go into, another section real quick, because this is a very natural segue into this. One of the things that I've definitely realized over, my experience of coaching hundreds, potentially even thousands of students at this point, that the biggest reason that people are unable to pass prop firms usually boils down to the fact that it's not that they don't understand the system, it's not that they're good, it's not that they're not even good at technical analysis, because the truth is, I'm going to use Bootcamp as an example. Phase 1 is the theory part. Phase 2 is in order to pass phase 2, I have to personally watch your backtests and kind of give you the green light, right? At that point, and my criteria for giving you the green light of passing, the practice phase and getting into the live phase is that I have to think that, based on you recording yourself backtesting, you're at a level now where the system is so intuitive that you could make my YouTube videos for me if you ever wanted to. And that's kind of the level you need to be. So if, the actual, theoretical part, so if the actual theory is not the problem, and if they've already done the practice to the point where, everything is intuitive, then clearly the reason why people are still not able to pass prop firm challenges or to just make good money from trading has to be something else. And that something usually boils down to psychology. And that psychology, I know it's a very general word. If I can boil it down even more, it's kind of like a fear of losing money, because it's super scary when you see on that screen, oh, minus $1,000, minus $2,000. That's a lot of money for a lot of people. But at the same time, if you break down the math, it's not that much, right? It's 50 to 100 bucks per trade. If you risk if you have decently sized, big account, and if you take on 1 to 2% risk, that's going to be probably $100, which most of you watching this are going to risk anyways on a single trade of your own money. But this time, for $100, you could potentially pick up a 10K account. If you have a 10% drawdown, your risk per trade is going to be $10, right? Think about it that way. It's whoa, that's not a lot of money. And it's not. And the beauty of that is that this allows you to risk the proper amount when it comes to prop firms, because it's absolutely stupid for you to be, risking, 0.25% risk on a prop firm challenge, thinking that you're smart because, you're managing risk. But in reality, like if you do that, you're just going to spend an incredibly long amount of time and effort, grinding a prop firm challenge without, like, you're going to be spending a lot of time and effort trading, but not getting any payout from it. So I'm going to share later what kind of like a strategy is to, when it comes to prop firms, but essentially boils down to pass fast, fail fast. Anyways, just going back to what I was talking about, when you remove that attachment to those big numbers, well, it becomes a lot easier for you to risk the proper amount, which means that, if previously, if you were risking like 1/10 of that usual size, it might have taken you like 50 winning trades in order to pass a prop firm challenge. Well, now you can do it in 5. So you can actually accomplish this in 2 weeks instead of 2 months, which in the past, the people that struggle with this, they tended to take 2 to 3 months to pass a challenge. Simple fix, boom, they're now passing it, at most within a month, in the event that market conditions are not that good. So simple fix, but that's, that's number one. Number two, a lot of the times when you see a big number on the line, when that number matters to you, and when that number is, of course that number matters to you, when that number is too big for you to handle, there's going to be something else that is playing out in your mind and in your heart when you're taking that trade. And that something is not going to be based on logic. It's not going to be based on reason. It's going to even be based on the system, right? It's purely psychological, which is, oh my God, this is such a big amount of money, right? You're going to put more weight to that trade. You're going to be, a little bit more afraid. You're going to be tempted to move your stop loss a little bit earlier, even though, on paper that, your stop loss is supposed to be like this. Because, oh, when you put it like that, man, I'm going to lose $1,000. Let me just, there's a little swing low down below here. Like, let me just move it to 500, like a $500 stop. Or you might be tempted to take profit early. And one thing to understand, like the thing to understand about this is that none of this is based on reason, none of this is based on the system or logic. It's purely psychological. And you don't want to be trading from a psychological standpoint, because feel is not a profitable strategy. So once you understand prop firm math in this way, and this kind of fixes everything. And the beautiful part is that, while it fixes these problems, it's going to start getting you on track to getting used to bigger numbers, which is, in the past, at least for me personally, before I started, prop firms, when I was scaling my own money, it was really tough for me to make the jump from, because for a very long time, $100 to $200 was like, it's a decent sum of money to risk, because in the event that I win, guess what? I've just paid for basically an entire week's of meals. That was back when I was still staying in Malaysia, and, life was still pretty cheap back then. But anyways, at that time, and the reason why I'm sharing this with you, you'll get it soon, but back then, $100 was, a decent sum of money. Now, the problem with getting used to, or rather getting attached to any sum of money, is that comes a point in time when your account grows, and now you're supposed to be risking $200 on a single trade instead of 100. You're going to struggle to do that because you're attached to that, number. You're attached to that money, and it makes sense. We work hard for our money, but the market doesn't care that you work hard for your money. Money is money. Capital is capital. Risk is risk. So all of this is kind of like self-imposed emotions, which again does not help with trading whatsoever. So one of the biggest problems that I had, and one of the, longest, kind of like phases that I got stuck at, was basically going from $100 of risk to comfortably being able to risk $250. And then it was even harder for me to go from like, $200, $250 risk to $500. And the biggest step I had to go was going from $500 worth of risk to the 4-figure range. And that's because it's a huge psychological jump to go from 3 figures to 4 figures. And one of the beautiful things about, starting your trading journey with prop firms is that no matter what, even if you get a 10K account, yeah, sure, you're still going to be looking at $100 worth of risk. But in the event that you pick up a 100K account, well, you're going to be starting to get used, you're going to get used to these bigger numbers. But in reality, you're only risking 2 figures on every single trade. And by the time that you want to start trading your own capital, ideally you should already be quite proficient in trading. You should have already gotten multiple payouts from prop firms, just to prove to yourself that, hey, if I look back at my trading, well, I've already gotten this many payouts, and I've gotten this much funding. I have this many months of data that I can kind of fall back on. I am now considered a profitable trader. And if that point you want to start trading your own capital, go for it. And you're not going to have any struggles whatsoever, because you already understand probabilities theory, you understand systems theory, you understand that all of this plays out. And as long as you stick to the system, you're going to be profitable long term, and you're not going to struggle with risking the proper amount on every single trade. And that's just something that I didn't quite add into the whiteboard, but it's something worth mentioning. So just understand that you don't really have much downside when it comes to prop firms, but treat it the right way. Now let's move into kind of the core philosophy, right? If there's one strategy when it comes to passing prop firms, quick and reliably without, doing stupid shit and being reckless, this is it. Essentially, it boils down to you want to pass fast or you want to fail fast. But let me explain. And I kind of put this in the kind of like Q&A, FAQ kind of section of the board, because this is also another problem, or rather a question that a lot of people tend to have in regards to prop firms, which is, oh, but what if I fail the challenge? We'll answer both of the questions at the same time. So let's kick things off with the perception that most people have towards prop firms. Most people tend to think that most people, at the very least, right, they put a lot of weight into a prop firm challenge, right? Oh, it's an exam. Oh, I'm being tested as a trader. Oh, these prop firms, they're gonna see that I'm not following my rules and I'm a shit trader, and they're not gonna give me money anymore. And like, no, the reality is prop firms are a business model. Right? It's a business model where they make an incredible amount of money from understanding statistics, basically. And just to break that down, we already know from, just rough estimations that about 90% of the population of traders are they're consistently unprofitable, right? They consistently lose money. And it also means that 90 to 95% of people that end up buying a prop firm challenge, they tend to fail it. And when you have, thousands, tens of thousands, hundreds of thousands of people paying, a few $100s for a prop firm account just to fail it like 9 times out of 10, and then they're going to come and retry it again, that's a lot of money that you stand to make from, people buying challenges. So the challenges are absolute, like they're just, it's just a transaction. It's a business transaction, and nobody's measuring like your trader profile or whatever. In the event that you fail to challenge, just get a new one. That's it. Like, they're not going to hold anything against you. You don't need to, like, for example, if you buy a $100,000 account, that the drawdown limit is $10,000. If you blow that account, like, you don't need to pay them back $10,000, right? It's a demo account. Essentially, like, you're playing with fake money. They're just seeing if, do you have the capability of, taking trades consistently, not over trading, not over risking, and just in general being a fucking degen. If you're able to prove that you're not, doing that while being able to hit the profit target without blowing up the stop loss target, guess what? You're a fund trader. You've passed. So, and it also applies to once you've passed your challenge, once you get into the live phase, it's not like if you end up blowing the account, you need to pay them back. Again, it's a demo account, or at the very least, 99% of prop firms use demo accounts even during the live phase. There's a very, very rare few prop firms that will actually give you live money to play with while you're in the live phase. But then like the way that they kind of adapt to that is that the exam, kind of like, in order to pass the challenge, and before they give you live money to trade with, they tend to be a lot more stringent with, their criteria. And they just need to ensure that they do their due diligence on you as a trader, so that whatever live money they are giving you, like, you're not just going to recklessly blow it up. But even if you lose it, you don't need to pay them back nothing. Again, your risk in prop firms is literally capped to the amount of money that you pay for the prop firm, and of course the time and effort that you spend into the prop firm. That much we can't really say much, but just the fact that this is an incredible trade-off if you know what you're doing, which is very low potential risk, very high potential upside. So right now you just got to get good at what you're doing, and prop firms are going to be I know it kind of sounds almost like, a magic pill or like a magic bullet, but the truth is, it is, right? 10 years ago, if you were getting into trading, you would have no choice but to either rely on your own capital or pray that you are able to apply to some sort of trading firm or trading floor, and there'll be someone to coach you, there'll be someone to give you capital. But nowadays, like, the game is wide open. Prop firms have never been more accessible. In fact, even compared to just 3 years ago, the landscape of prop firms was completely different, right? Just to give you an example, most prop firms now don't give you any sort of time limit to, pass a challenge. In the past, you had to hit a 10% profit target within 30 days, which is not always, that achievable unless you're properly risking the proper amount on every single trade, and you had to have a pretty decent month, right? Again, 10% gain is nothing to scoff at. It may not feel like much if you're coming for crypto, but again, just to give you an idea, but when you're coming from a TradFi perspective, this is huge. If you're able to maintain 10% a month with a decent amount of capital for a long enough period of time, you're going to be making an absolute killing from trading. So anyways, now let's get into kind of like the core philosophy of, basically passing prop firms, which is like, again, I've already, kind of prefaced this multiple times throughout this video, but essentially it boils down to pass fast, fail fast. Now that you understand not only the business model of prop firms, but you also understand prop firm math, you also understand your downside risk is cap. In this sense, like, again, the biggest reason that I've seen across hundreds of examples of people who are perfectly proficient when it comes to trading, and they understand the system, they understand technical analysis, but they still do not reach the point of just consistency or just profitability. It's purely on the fact that A, they're not risking the proper amount of money that they should be, or B, there is, some other kind of like psychological thing that is affecting them. Now, usually that tends to also boil down to a fear of losing money, which again, it is completely valid in the event that you're trading your own capital and you've worked hard for that money, and you have to risk a meaningful amount in order to make a meaningful amount back. But when it comes to prop firms, it completely changes that equation, because if you think about the fact that you're only risking like $25 a trade, like if you're afraid of risking $25 a trade, then like maybe it's time to rethink your life. But like in general, like all right, that's in general. If you got to rethink your life. But if you're like the truthful answer, if you're afraid of risking $25 a trade, if you put $25 on the line and you feel some sort of way and you feel the need to kind of like mess around with the trade because you're afraid of risking that money, then you really got to change your perspective with risk or potentially money. In which case, I would probably point you towards, what, I don't even know what to point you towards other than the fact that maybe start with $10 risk per trade or $5. If that helps, pick up a 5K account, pick up a 10K account, and it's going to make it so much easier. But otherwise, just to go back to that core theory of like pass fast, fail fast. Essentially, when it comes to prop firms, just remember this one thing: the longer that you spend grinding away on a challenge is the longer, it's like the more time and effort that you're going to put into trading, but you're not going to be getting any payouts from it. So save the smart risk management for after you've passed a prop firm challenge. Once you get into a live account, and now you just gotta make a couple of percentage, maybe 5% a month, without blowing up the account, so that you can do this for many months and just extract a lot of profit from that initial investment of a couple $100 that you put in. Like, do the risk management at that point, right? If at that point you decide you want to go for 0.25% risk per trade and 0.5%, and you never want to touch 1%, absolutely, by all means, go for it. But not during the challenge phase, because during the challenge phase, think about the money that you're putting in, right? And whatever that amount is, like, this is why you also see people that are able to pass prop firm challenges within the same day, taking like 1 to 2 trades. No, that is not gambling. It's just they've done the math. If they're used to risking, $500 to $1,000 a trade, even on their own personal money, and the prop firm account costs $500, and as long as they have the rule that allows you to pass in one day without any, consistency rule, then yeah, I might as well buy like 5 of these accounts and treat them as 5 separate trades so that I can pass it in a single day. And whatever, the trades that I win in the future is just going to be kind of like house money. So now, obviously, you don't want to just start off by doing that, but just understand again, basically, if I could give you a very practical rule to apply when it comes to prop firms, you never want to be risking less than 1% on the challenge phase, right? Ideally, if you have a kind of like an A+ setup where everything's kind of aligning and you have like every criteria checking out plus some bonus confluences, then go for 2%, or the maximum amount of risk that your prop firm is able to allow you to risk on a single trade, which, depending on the prop firm, it's going to completely differ in the sense that some may be 1%, some may be 2%, some may be 3%. Now, the only way that you're going to be able to find this out is if you go read the rules, which I highly encourage you to do, but we'll save this for later, because I'm just going to share some notes when it comes to, what you should look for when it comes to prop firms later on. But just understand, 1% is basically your half risk trade, and 2% is basically going to be your full risk trade. Now, when you do this, keep in mind, I am kind of referring to this from the perspective of a 10% drawdown account. So in the event that you, let's say, have 5% drawdown, then you kind of want to just half that number. So 0.5% risk for half risk and 1% for your full risk. Now, I'm going to get into what's the differences between the drawdown limits later, but essentially when you're dealing with a 1-phase challenge, you're going to have, usually 3 to 5% drawdown limit. When you're dealing with a 2-phase account, you're going to have anywhere between 10 to 12% of a drawdown limit, which is a lot more forgiving. But at the same time, with a bigger drawdown limit, it means the more target you actually need to hit, which means, if you if you use the same kind of risk parameters for both of these accounts, then yeah, you're still going to take a couple of months to pass the challenge, which is not what you want. Or at the very least, which is not what I want for you. Ultimately, you're here to make money trading, but if you can get it done in a month rather than 3, then wouldn't you rather get it done in a month? So obviously, when you take this approach, you are going to fail more accounts, which again is perfectly fine. It's just a business model after all. And if you really break down the numbers, all you're losing is a couple $100, right? Again, when you think about it that way, not that big of a deal. When you fail an account, it's not that the prop firms are going to ban you from ever, taking another challenge. In fact, they would love for you to try another challenge so that they can take, or rather they can have the potential to take more of your money. There is no shame in failing prop firm challenges. In fact, even better, it just shows that, you're risking the proper amount on every single trade. Everyone's going to have a couple of losing streaks, but as long as you have proper risk management, and if you trust the system and you just so happen to kind of run into a losing streak and you blow the account, fine. It's not that big of a deal. It's yeah, just start fresh. basically, in the event that, you potentially, down 8% on a prop firm and you have 2% drawdown limit yet, and you have a 2% drawdown limit left, it's better to just kind of like, in a way, it's even better to just kind of like start a fresh account, right? Obviously try to recover that account, but don't put like your entire mind, human and soul and being, whatever, into kind of like recovering that account. Oh, I'm going to take 0.25% risk here until I kind of get back to 7%. They're going to up it to 0.5% risk or whatever. No, like if you're down 8%, like that's 8% you have to make just to get back to break even. May as well save that time, spend another $100, get a new account or something, or like risk the last 2% on like a final kind of like A+ trade. If you win it, great, you made 4 to 6% back, and then boom, now you're back at break even. Or heck, for $100 you can kind of like start fresh and you have a new account, right? Again, just don't. At the end of the day, all I'm trying to say is that when it, like, just remove that attachment from prop firm accounts. They are not, like, it's no big deal, right? Especially in the challenge phase. When you get into the live phase, great. Like, it's real money now. You actually, whatever money that you made there, you can actually get a payout. Great. Treat it seriously. But a challenge, yeah, just pass fast, fail fast. If that's the one thing that I can leave you with, it is going to be that. Anyways, I think we are now getting close to the end of the kind of like overall strategy stuff. Later on, I'm going to give you more of the technical stuff. I'm also going to kind of go through a couple of prop firms just live alongside you guys, just to explain some different terminologies so that you are not, absolutely confused when you go into a prop firm website, which I understand only are the amount of prop firms out there. Absolutely confusing, and honestly, there's way too many. But even the amount of terminologies and just jargon is just like, yeah, it takes a while to get used to. So just to answer one last kind of like FAQ that I've gotten asked many, many times is that, oh, hey, what if I don't want my money to, be in the control of somebody else? You don't have to. When it comes to prop firms, there are like, what you'll kind of understand later is that there's a difference between short-term accounts and there's a difference between long-term accounts. And when it comes to prop firms, right, again, your downside risk is very much capped. All it takes is one payout and you've kind of like made back multiple times the investment that you put into the account in the first place. Everything else on top of that is just a cherry on top. You don't need to risk your entire livelihood on the fact that the prop firm is going to continue to exist, that they will continue to pay you out, or on some other factor that is outside of your control. Whatever money that you take from your payouts, feel free to cycle it into a personal account. Feel free to cycle it into more trustworthy prop firms that have been around for like the last 20 years. No, sorry, not 20 years. At the very least, the last 10 years, which is quite a long time in the prop firm industry. And then get some long-term accounts there so that, you will never run into any issue. Or heck, put it into investments, right? Crypto, real estate, whatever it is. Like, prop firms can be as long-term or as short-term as you want. In fact, there are different strategies. In fact, you could have long-term accounts while you, kind of gamble on short-term accounts. It's perfectly valid. Again, at the end of the day, prop firms are just a way for you to get capital. And whatever you do with that capital, which, ideally you should be making money from that capital so that you can, again, put it into yourself. And so you don't have to, in the event that the prop firm decides to ban you for whatever bullshit reason, if they decide to deny you a payout for any reason, it's no big deal. You've already acquired some money. You have diversified your kind of like holdings across multiple different prop firms. Even if this one, goes away, boom, you have like 3 other accounts. Yeah, this is honestly not a super big concern. And if there's honestly one thing that I would like you to consider, is that how about you think about this problem once you actually make money or, get profitable? So many people come to me, so many people have come to me over the years, asking this question and that question and that question. That's like kind of like step 5 or step 10 when they haven't even begun, step 1. Some problems, deal with it once you actually, make money. It's kind of like taxes, you wouldn't worry about taxes if you're not making money, right? So is taxes going to be something that you consider before you start a business? Because, oh man, I'm going to make so much money, taxes are going to be crazy. No, it's a stupid question. So just focus on making money first and thinking about all of this later. Honest opinion. But otherwise, now let's get into the 2 types of prop firms. So essentially, most prop firm accounts and most prop firm challenges are going to be split into 2 broad categories. The first one's going to be a short-term account and the second is going to be a long-term account. Now, the only differences between a short and a long-term one is that a short-term one, your goal and priority with that account is to basically get the payout. Ideally as safe, as reliably, but as fast as possible. Once you get that payout, everything else is kind of like house money, and it does not matter at that point if you blow the account up. Now, the reason why I'm saying it from this perspective is because usually when it comes to short-term accounts, they tend to be one-phase challenges, which their drawdown limit tends to range between 3% to 6%. Now, if you've been in trading for any amount of for any period of time, you understand how easy it is to lose 3%, right? All you need is potentially a losing streak of 3 to 5, and boom, you've lost the account. So Instead of looking at it as like a long-term, like I'm going to have this for many, many years, treat it as what it is, a short-term account, right? Again, another misconception that people have when it comes to the differences between one phase and two phase challenges. Like one phase, you're getting quick, kind of like do a pump and dump, right? Once you get your money, once you sell the top, boom, cycle it into more one phase accounts or cycle it into somewhere else. But the goal with a short-term challenge is to make money fast. And this is like, as we'll get into later with the prop firm strategy, we'll always recommend beginners to start with a one phase account, at least for their first couple of accounts, or at least until they get their first payout. Only after that, start thinking about long-term accounts, because it's an absolute waste of time for you to be buying a two-phase challenge, which now we're going to get into, where you have a drawdown limit of like 10%, which is great. Oh, I can lose 10 trades in a row before I blow up the account. The problem is your target, right? The profit target in order to pass the challenge is usually going to be double to a little bit more than double compared to a one phase account, where it's going to range anywhere between 12% to maybe 15% on the high end. And that essentially also means that unless you're risking the proper amount, it's going to take double the amount of time for you to pass the challenge compared to one phase. It's going to be double the amount of time for you to get your first payout compared to the one phase. And like your initial kind of trajectory as a trader is highly determined by that first couple of payouts, because the moment you start feeling like, okay, I'm not risking my own money anymore, but I'm just risking house money, that's when trading kind of opens up. Again, just to go back to what we were talking about before, where the majority of trading problems can kind of be boiled down to one thing, which is a fear of loss, right? Most people are afraid to lose money. Most people don't want to lose anything. In fact, like it doesn't feel good if you happen to lose something in your life, right? Money tends to be a pretty big component of that. If you're able to kind of like remove that attachment from money and just be like, okay, whatever money here is kind of like what I've made from trading, and I can lose this entire payout buying new prop firm challenges. I can lose all of these prop firm challenges and I'll still be fine, because technically, like, this is house money. Once you can get to that phase, that's when trading really takes off, because again, you no longer have that attachment to money. Now, if you're able to get to that point without needing a payout, to the point where you already have a good relationship with money, you're already, kind of in a good spot in life, and perfect. You want to be a little bit more aggressive when it comes to the strategy that you use with prop firms, right? For one phase challenges, you could realistically pick up like 25, 50K accounts for like $100, $150. And if you have a 3% drawdown limit, heck, go 1% risk on all of them. Like pick up a few at the same time once they run promotions, which is another thing. Like, yeah, since I'm on this note, like, let's just talk about it. When it comes to prop firms, like a lot of these tend to run promotions all the fucking time. Like if you take a look at Apex, they have 85% off basically, 300 days out of 365 days of the year. When it comes to just the majority of these prop firms, they always have some sort of a promotion going on. So if you see that they are currently in a state where there is no promotion going on, just wait like 2 weeks, because every month there tends to be something and it's usually worthwhile. It's 20, 30, 50% off. Like it just makes whatever that number is on paper, like $200 could become $100 of your own investment. That just makes things a lot easier. Now, just to get back to the prop firm challenges, talking about like one phase account, you already understand the one phase account. Now let's move into the two phase account. Now, the reason why this is called a two phase account is that, okay, usually with two phase accounts, you have a static drawdown. Now, I just realized there's also something that I forgot to talk about with the one phase challenge. There are two different types. In fact, we'll talk about this later. In fact, I am going to share this later once we go onto a prop firm website, and I'll kind of break down every single terminology out there that you need to understand. Now, the reason why a long-term account is usually a two-phase account is because only on two-phase accounts do they give you more than a 10% static drawdown limit, which means that, 10% is a healthy amount where you could lose 10 trades in a row. And granted, not every single loss is going to be 1% risk. Like some could be 0.5, some could be 0.25, especially once you reach the live account phase. Then like, yeah, you basically have the leeway of like 20 to 30 losses in a row before you blow that account up, which basically makes it near impossible for you to blow up a two-phase or kind of like a long-term account. Again, the reason why you wouldn't want to do this at the start is because, like, again, different kind of goals here. Long-term accounts, you would usually look to have it for many, many months. And so when it comes to long-term accounts, you also want to ideally be investing into these long-term accounts with reputable prop firms. Some of the best in the game are the ones that have been around the longest, right? FTMO and Fidus are two of basically like the creme de la creme, if you can put it that way. But either way, with a long-term account, like you don't want to start off with this, but just understand like there's nothing wrong with either kind of approach, but depending on where you're at in your trading journey, you want to prioritize short-term first, and then cycle it into long-term later, especially once you've gotten a couple of payouts. With the long-term account, one of the different kind of like things compared to the short-term account is that you are looking to maintain, especially once you pass the challenge, you're looking to maintain the account. Again, you're looking to have this for many, many months and potentially years. Different to a short-term account where you are literally borderline gambling, where you're trying to get payouts, consistently, quickly, but still done in a way where you're following the system, so safely. With a long-term account, you want to be a little bit more safer with this, right? Don't go more than 0.5% risk per trade unless you see an amazing, like A+++, not only is everything in the system aligning, but you also have some bonus confluences on top of that. Yeah, feel free to go 1%, 2% if you want. It's completely up to you, and get a big fat payout for that month. But the goal with the long-term account is you want to play it safe, right? Because at the end of the day, if you tell someone that, oh yeah, you're a trader, only makes 3% a month, they're going to be like, you're not that great. And you tell them, oh, but I have $1 million in capital. Oh. See, that's what you do with the long-term account, right? The actual on paper kind of like vanity metric of gain percentage, not high. But once you have enough capital, that's when things change completely for you as a trader. Now, let's get into the prop strategy, which I think I've kind of already prefaced this, but you always want to start with the one phase challenge, almost always. Now, the one that I would recommend for most of you watching this is going to be Apex Trader Funding. we'll go onto their website later just so I can explain a couple of things for you. Yeah. Apex, why? Because they usually run 85% off kind of promotions, which also means that their accounts go from, $150 for a 50K account to $30 for a 50K account, 50. Apex exclusively does one phase challenges, which means this is the perfect kind of starting point to getting your first payout. Now, the bonus part of Apex is that they're also one of the most transparent prop firms out there, in the sense that they have some of the highest approval ratings when it comes to payouts, and they do it really quick. Basically, chances are you're not going to run into them denying you a payout or banning you for some stupid bullshit reason, because A, they're quite reputable, B, they're incredibly cheap, they have one phase challenges, and they have a good reputation. So that's the one that I would recommend for most of you watching this. I wouldn't overthink this, which later on, once I get into the prop firm kind of website, one of the things that I will tell you is not to overthink it. In fact, one of the rules down here is to not overthink it, because it's really easy. But let's get to that once we get to that phase. So once you have your one phase challenge, connected to MT5, connected to TraderView, connected to whatever trading method that you would prefer to have, and then again, look to pass fast or fail fast, right? A challenge is just a challenge. It's just whatever money that you would have risked anyways on a single trade that you would take with your own money, but now you're spreading it out and diversifying that risk across different prop firms. To pass fast, fail fast, don't be attached to the challenges. The challenges are absolutely nothing. Once you get into the live, feel free to get attached to it, because now you have, real stakes at hand. And then lastly, when it comes to when you pass a challenge, right? One of the rules that you always want to have when it comes to, just prop firms is that you always want to buy another challenge the moment you pass any challenge, right? And when I say at least another challenge, what I usually do is I buy a couple of challenges once I pass any challenge. And the reason why you want to do that, it comes down to kind of diversifying your risk, but also kind of scaling. And I'm going to explain that. So when it comes to diversifying your risk, there happens to be some day where some prop firm decides to ban you or deny you a payout for whatever reason, boom, right? If you only have one account, if you've never kind of started working on other accounts, guess what? You now have to start from zero, and chances are for the next month, you're probably going to make nothing from trading, because now you have to, start over from scratch. Now, when you always make it a point to buy new challenges and to work on these new challenges the moment you pass one, means that A, you're always diversifying your risk. In the event that this platform goes away, boom, right? You have this other one that's already kind of 2% away from passing, and all you need to do is bang bang, and you have some, you have a way to acquire income for that month. Secondly, you're always scaling. When it comes to prop firms, it shouldn't be oh, when I think I want to scale, then I buy 20 accounts at the same time, right? Why not go slow and steady? Just build out from 1 to 2 accounts, 2 to 4, 4 to 5, and then 5 to 7, and whatever. Over time, naturally, as you continue to do your thing, you're already going to do this anyways. You're already going to be using the system. You're already going to be trading. Over time, you'll naturally scale if you do this, which one of the ways that we're going to manage all of these accounts, because at some point you're going to reach the point where you have 10 accounts. You're not going to be trading 10 accounts individually each and every single time on 10 different phones or whatever. You're going to have one centralized kind of hub, which is called TradeSyncer. That's the one that I recommend when it comes to these trade copiers or account copiers. And you're just going to take a trade on the main account, right? The main account, and it's going to copy trade, right? It's going to place a similar kind of risk percentage, same asset, same position, everything across all of your other accounts. And that's how you that's how these prop firm traders basically trade, $2 to $5 million worth of capital spread across 20 different accounts. They do it using an app like this. Eventually you're going to get a payout. Once you're done with your one phase challenges and you get a couple of payouts, that's when you kind of start working towards two-step challenges. So just understand, but yeah, that's in general the prop firm strategy. It's not really that complicated, to be honest. It's really simple even. So now let's get into some of the things that we need to consider with firms. So this is also one of the other huge talking points when it comes to prop firms, which is, oh, but I'm not getting into this prop firm because it has a negative review. Like, no shit. They're going to have negative reviews on every single prop firm out there, even the best ones, FTMO, Fibers, whatever. Always going to see negative reviews. Why is that? Because, like, just think about it for a moment, right? If you have an absolutely horrendous experience at a restaurant versus an absolutely fantastic experience at a restaurant, which one are you more inclined to talk about? Chances are you're gonna, go online and, trash this restaurant, like, oh my God, the waitress is so rude, or blah, 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 because you had a negative experience. And it, at the very least, makes you feel better if you kind of vent about it, and if you kind of like, it feels like you have been wronged, and so you try to get back at the restaurant. Same thing with her profit, right? If they happen to be denied a payout or whatever, for whatever reason, whatever, like, they're gonna go online and they're gonna, yo, I put in so much work, but you denied my payout, blah, blah, blah. Like, it's always going to happen, and it's not always the fault of a prop firm. In fact, there is no prop firm out there that will not have any negative reviews. Like, for whatever reason, there is going to be someone talking about it, and the voices of the negative people are always going to be louder than the ones that are really positive, right? It's the reason why, news tends to be so negative most of the time, because nobody cares about positive stuff. Everyone only cares when it's negative. Negativity sells, basically, So even with prop firms, negative reviews are always going to be more prominent than the positive reviews, and it's just kind of like the way human psychology works. So yes, you are always going to see negative reviews. Now, what matters is the overall reviews, and secondly, how long they've been in the space tends to also be like a pretty good kind of like benchmark for quality when it comes to a prop firm. But in general, like reputation and like the overall reviews, as long as there are enough people using it, and if there are enough people kind of like speaking about it, and most importantly, if you go to a website like propfirmmatch.com and you see that it has pretty decent reviews, chances are you're going to be fine, right? Some of the longest players in the space, like, you could definitely name them off the top of your head. Chances are you're going to be fine with those. Are they a little bit more expensive? Yes, but would you be happy to pay for a little bit of security? I would assume yes, if you're someone that is concerned about things like this. But just understand, like, on every prop firm, the offerings are going to be slightly different, training rules are going to be slightly different. But one thing for sure is that you're always going to see negative reviews, and that is perfectly fine. Even some of the worst, like, the worst kind of like PR prop firms out there, they're still around and they're still paying people out. Obviously, given the choice, you wouldn't go for those as your first option. Oh, but one other thing before we move into the second point within this kind of like segment is that, like, above all else, what you want to kind of like specifically look for outside of overall reviews and just like general like trust and reputation within the space is transparency. Essentially, like, ideally, they should not be banning you for bullshit reasons. That's honestly the most annoying part about prop firms. It's only happened to me a couple of times throughout my many years of trading and across trying out different prop firms. So it's very much the exception and not the rule. And those are only because like those prop firms were scammy as shit, which kind of like the second point this segment is going to kind of like talk about that. But just understand that nowadays in 2026, as at the time I'm filming this, I believe 99% of the prop firm industry is so competitive nowadays because of how many players there are in the space that very little prop firms can actually afford to maintain a bad reputation anymore. So most of the time what they'll do is they'll use kind of like the fine print within the rules to kind of like hold it against you. But again, that is way rarer these days compared to back in like 2022, for example. And even when it comes to the rules, it's as simple as giving it a quick read when, before you sign up to the prop firm, just to make sure that it fits whatever trading strategy that you are trying to use. But for the most part, if you're trading the AOC model, whether it's the scalping model, the intraday model, I wouldn't quite say the same for the swing trading model, but as long as you're doing intraday or scalping, then you're going to be perfectly fine with the majority of prop firms out there. It's not going to be any concern. You will never breach any sort of rules as long as you follow the rules of the system. Now, if you're trading swing trading, then you want to look specifically for prop firms that support swing trading, basically prop firms that allow you to hold trades overnight, because not every single prop firm does this. If you happen to sign up to something like Apex, for example, you can't hold trades overnight. And if you do, then you're going to get flagged and you're going to be like, hey, you broke a rule. And so that would be a reason why they might reject the payout. But usually if you make if you break a rule once, it's usually fine. If you break a rule twice, it's still fine. But 3 times is when kind of like, you might lose the account. But it's a simple fix. All you need to do, read the rules a little bit, take 5 minutes, understand some English, and generally we're going to be pretty okay, right? Nowadays, the prop firm industry, just again, because of how competitive it has become, like, people are now forced, like, and it's a good thing, by the way, where these prop firms are now forced to be a lot more transparent in their, writing and in their rules, so that, they're not getting called out by the entirety of Twitter, and, then they're just basically going to lose their entire business, because nobody's ever going to want to use that prop firm anymore, because everyone knows that it's a scam. Next up, speaking about scams, let's move into the second point of this segment, is that if it sounds too good to be true, it probably is. Like, if they're offering you like a 200K account for like $20 and like just incredible rules that just like, wow, they promise the world. If it sounds too good to be true, chances are it is. So it doesn't mean that you should avoid it entirely, but in the event that you do decide to go with a prop firm, maybe go for the one phase challenge. Maybe start off with a little bit smaller of an account so that you're not spending too much money on it. And lastly, like just try to pass it. Who knows? You might even get a payout. And because if the rules are that great, if the rules are kind of like, whoa, for relatively little, you can get a lot. And if you get one payout, then, that kind of makes money worth it. So it's a lot like market conditions where, you can't really control that the prop firm, like you can't really just tell the prop firm, what not to do. But at the very least, you can adapt to it by, A, buying a smaller account, B, going for a quick payout, and then, pump and dump. And C, you might even realize, oh yeah, maybe what they're promising is true after all, and you might have just discovered a hidden gem, but you'll never know until you try. But in general, like if you're someone that worries about things like that, just stick to the reputable prop firms. There are more than 10 that I can count, and they're all going to be pretty decent. Some are better than others, but in general, again, because how competitive this space has become, it's kind of like forced the floor of prop firms to be really high in the sense that, there are not that many bad players in the space anymore. There are not that many bad apples in the space anymore. So like generally speaking, you're going to be good no matter what. Like things to consider with prop firms, definitely read the rules. It's worth it. I know it's going to take 5 minutes out of your day to just kind of like make sure that whatever the rules the prop firm has is kind of like fitting with the AOC strategy, which again, most of the time it will, but still read the rules. It's super worth it. So things that you want to look for is overnight trading in the event that you are doing swing trading. You also want to look at their risk rules. For example, certain prop firms will allow you to risk up to 3% of your account on any single trade. Some will only allow 2%, and some are actually, I don't think there are any prop firms out there that still keep to 1%. But back in the day, there was. Anyways, nowadays, it's either between 2 to 3%, and it's just good to get an idea so that, if you have a 50K account, you understand, all right, if I only have 2%, I don't want to be risking more than $1,000 in this trade, even if I'm on the two-phase account where, Suen says that, on A+ setups, you want to take 2% risk on that trade. Well, then make sure your max is actually 2%, right? Because if you end up going 3%, where the rules say 2%, then yeah, then you might run into some issues. And then it's not the problem with the prop firms. It's just that you did not take the time to do some due diligence. Moving on, it's like kind of like their rules when it comes to copy trading. Now, obviously, you're not allowed to copy somebody else's trades, but if you're copying like your own trades using TradeSyncer, where you have multiple accounts with the prop firm, which by the way, most prop firms allow you to have multiple accounts with the same prop firm. And of course, they expect you to use some sort of software in order to copy the trades amongst, all of these accounts. That's perfectly fine. For 99% of the prop firms out there, obviously you can't copy other people. Some of them allow you to use like trading bots, some do not. Some of you allows you to do, kind of like take multiple trades in a day. Some of them allows you to do like high frequency trading, some do not. Like again, at the end of the day, every prop firm is different. All of their offerings are slightly differently. They are catered towards different types of audiences. For example, Apex, they're all one phase challenges. Like nobody in their right mind is going to look at Apex and think like, okay, this is the perfect long-term account. I'm going to have each and every single account for years and years and years, because the truth is right now, every account that they have a maximum kind of like payout limit of like 6 times, right? You can take 6 payouts from that single account and then you have to start a new one, which is perfectly fine as well because of how cheap it is and the super low barrier of entry. But either way, like just take a, just have a read, like when it comes to payout rules. Just to give you an example, with Apex, like you have a, like, let's say you get a $50,000 account, you pass it. It's not like, if you hit $500 of profit, you can just withdraw that. No, you have to first hit $2,600 in profit. Sorry, you need to hit $2,100 in profit. Anything above that, you can withdraw. So just small rules like this that, in this case kind of only applies to Apex. I can't think of other, prop firms that would have you needing to hit like some sort of like that high of a minimum. But in general, it's still good to know, and it's not going to take more than 5 minutes of your time just to read through this before you decide you want to sign up and you decide you want to pay for the account, And well, like just one last thing to keep in mind is that when we get into the actual website of the prop firms later, you are going to see that there are an incredible amount of, technical jargons. When you start to check out, they're going to give you options to where, oh, would you like to have your profit split go from 80% to 90%? Or would you like to have 1-day consistency rule? Would you like to have this? Would you like to have that? Would you like to have halal trading? Which is a thing, by the way, like to make it legal for Muslims to trade. And essentially, the TLDR of this is that you will probably be tempted to look this up. You will be tempted to ask me questions on like, oh, should I get this? Should I get that? The truth is you don't, especially when you're first starting out. In fact, until today, like I've had more than 10 prop firm accounts and I've never once bought any sort of add-ons to it, unless like occasionally, like for example with CFD, knowing that I am investing into this account for the long term. It's a $200,000 account, and maybe I would, like for this specific account, I would like to pay up profit split to be not 80%, I would like it to be 95%, right? I pay for that. But that's something you think about once you've reached like beyond step 5, right? It's a problem that once you started making money, you think about taxes. You don't think about taxes before you've made money, that kind of thing. So like TLDR for the majority of you, for your first like 5 accounts, don't even think about the add-ons. Like feel free to research it in your own time if you want, if you're curious, if you're interested, but in general, you're not going to need it. Lastly, yeah, we'll get into TradeSync. Now there are usually like 2 kind of like main, these Traders Connect, the other one's called Traders Connect. The reason why I recommend TradeSync is that, in terms of it's a lot more budget friendly compared to Traders Connect, because Traders Connect, you kind of pay $10 a month for every account or like every connection you have to the main account. But with TradeSync, it's $50 flat, I believe, or around $40 per month, but you get 20 connections for that money. So essentially, if you have 20, like as long as you're not trading with more than 20 accounts, in almost every kind of scenario, basically, if you're trading with less than 2 to 4 accounts, then yeah, maybe Traders Connect might be a bit more worth it. But chances are, if you're watching this video, chances are, if you're in Blueprint, if you're in Bootcamp, you are going to reach the point when you have more than 5 accounts, just because like you are going to get good at trading, and there will be absolutely no reason for you not to get more accounts. So in this case, like you might as well get used to TradeSync. So it's like, in terms of the software, I don't think that's too much that's different between TradeSync and Traders Connect. Feel free to look into it, but TradeSync is the one that I use, and like it's the one I can recommend. I haven't had any issues with it so far, and you have a lot of flexibility when it comes to designating which main accounts, what assets to trade on each account. Like for example, you can literally like categorize accounts based on like, okay, only these 2 accounts will, if I take any trade on let's say gold, then only these 2 accounts will kind of like come into play. If I take on Nasdaq, then both these accounts will not. Stuff along those lines, right? I'm not going to get too deep into TradeSync in this video. Just feel free to go on YouTube. Like there are a bunch of tutorials. It's not something that's incredibly difficult to figure out. But yeah, connecting accounts just gives you the ability to basically trade 10 accounts without absolutely losing your mind, because you have to now have 10 different phones or like 10 different apps, whatever. You have 10 different logins, and you have to execute trades 10 different times. Like it's a no-brainer, right? And again, because of one of the rules of scaling when it comes to prop firms, is that every challenge that you pass, you want to start a second challenge immediately, in a sense where even if you end up, okay, let's say you pass a challenge and now you're on the live phase and you reduce your risk by half, right? Instead of taking 1% risk per trade, now you're getting 0.5% risk per trade. Doesn't matter. You can still use that as your main account, as long as whatever trades that you're taking on a live account, as long as your other account is kind of like building towards passing, right? That's what matters, because you just want to protect yourself against the potential of, one day you might potentially lose the account for whatever reason. It can happen. Then you have to start from scratch. But if you've just been, working on other accounts while you're making money, guess what, right? Not only will scaling be a lot easier, but it kind of happens on autopilot as you just do your thing. But secondly, in the event that anything does happen, you're not starting from scratch. You already have a couple of other accounts ready, and that is a good place to be when it comes to trading. Just having that sense of security. So yeah, that is most of the module here when it comes to prop firms. This is surprisingly going on for more than an hour at this point. But now let's just get into a couple of prop firm websites so that I can show you some of the terminologies that are involved when you are about to sign up for a prop firm. Let's take a look first at Apex. So let's go into Explore Products. All right, so let's take a look here. When it comes to Apex in general, right, you have 2 different types. One is an intraday trail, where basically the trading stop loss is calculated based on intraday. Basically, if you hit the stop loss at any point in time, like it will be calculated instantly. And you have end of day, which means that, even if you're down below the stop loss limit before the day ends, if you can somehow get back above the limit, then your account won't be blown. Now, personally, I don't really think that this matters a lot. I would just go for intraday most of the time, because if you have, like, again, pass fast, fail fast, with Apex, their offerings are all one-phase challenges. It's not like you need to keep this account for the long term anyways. If you lose it, you lose it. Like, you get another account. In fact, taking a look at the prices for the account, like, check it out. For $25, you can pick up a 50K account. Like, how ridiculous is that? I can pick up 20 accounts right now, and for like $500. Can you believe that? So again, like, yes, you have a 3% drawdown limit, which I'm going to get into that now. As an example, let's say we're looking at the 50K account, and we're going to use Tradeovate as our execution platform. Well, your minimum days to pass is essentially like, if I happen to take one trade today and I hit the $3,000 profit target, it means that I pass the challenge. Like, I get to have my account immediately, right? Because the minimum amount of trading days is 1. In the event that you have 5, you can hit the profit target on the first day, but you still have to just take some couple of trades, like small ones, throughout the rest of the 4 days, on 4 separate occasions, so that you can hit the minimum kind of days required to pass. That's all that means. Most of the time, you're probably not going to be passing it in a day. And most of the time, the kind of like limit that prop firm set for you, or like the rule that prop firm set for you in regards to the amount of minimum days like the minimum amount of trading days that you need is usually quite friendly, right? It's anywhere between 3 to 5 and potentially 7, which makes sense, right? You're not going to hit 10% profit target in a single day. Even if it takes 5 days, it's a fair amount, right? Let's just keep it that. Now, max contracts means that, you're able to open 6 contracts of NASDAQ mini, or you're able to open up 60 micro contracts. Profit target is, 3K based on a 50K account. You can do the math. This is 6%. The maximum drawdown that you have is that you cannot lose more than 4% of the account. And again, this is an intraday trail, which means that it's going to be cheaper compared to the end of day trail, because like it's easier for you to lose the account, but at the same time, it's like with Apex, it doesn't really quite matter. In fact, Apex is the only one that I know that does separation between intraday trail or end of day trail. But either way, like, let's take a look at just more stuff. So your daily loss limit. Now, every prop firm will have some sort of a daily loss limit, which basically means that you cannot lose more than a certain amount in the same day, right? Once you hit that number, do not continue to trade, because if you continue to do it, you are going to violate a rule within the prop firm. This is just to prevent traders from just blowing out their account in a single day. Most prop firms have this, and like, just it's usually pretty transparent. You'll see it on the front page of the prop firm. Scaling. This basically means that, with some prop firms, there is no scaling built in, where if you get a 50K account, you're just going to be trading with a 50K account for the rest of the time. It's not going to grow into anything more. There are some prop firms that have scaling. For example, every payout that you take that is worth at least 5%, for example, your account will grow by 5% in terms of capital. So the next month, after you take the payout this month, next month you're going to trade with, instead of 50K, you're going to be trading with 53K as an example. And then that kind of keeps compounding. Now, this depends on the prop firm. Is this a reason for you to choose this prop firm over the next? Absolutely not. Scaling doesn't matter, because like, for a couple $100, you could scale right then and there. You don't need this. Is it good to have? Yes. But should that be a top consideration? Absolutely not. And then reset fee, this is basically like, this usually applies to essentially, like, you can pay a fee to kind of like reset the account. Instead of having to pick up a new account, let's say you're down by 8% right now and you're 2% away from failing. Like, instead of buying a new account for maybe like 200, maybe the reset fee is $80, and you might find it worth it to just kind of reset the account back to 0, and then you can start from there again. With Apex, the reason why there is no reset fee is because this is only like, each account is only active for 30 days, right? Again, when I say that Apex is a one-phase challenge and your goal should be to pass fast, fail fast, this is what I mean, right? You have 30 days to basically make 6% or to blow the account up, because otherwise you're going to lose it after 30 days anyways, right? So that's why there is no reset fee when it comes to Apex, but majority of other prop firms, you should have some sort of a reset fee. Now, depending on every prop firm is going to have different kind of like execution platforms available to you. For example, TradeAvate is directly available on TradingView, which means that you can place trades and close trades directly on TradingView. Now, can you use TradeAvate on the browser? Yes. Can you use TradeAvate on mobile? Yes. Can you use TradeAvate on Mac? Yes. Can you use TradeAvate all of this is TradeAvate, and obviously if I go into Rhythmic, which is another execution platform, this becomes a little bit different, right? So Rhythmic would not be available on TradingView, for example, but TradeAvate is. So that's about it when it comes to this. And essentially, like, Apex is absolutely ridiculous. 90% off. Incredible. But yeah, that's Apex. Let's look at, another popular one, which is Crypto Fund Trader. This is a really popular one. It's one that I've used before. This is the one Sid uses. He's funded for like $500,000 with them. And a lot of people within the AOC community are using this, because this is one of the only more legit kind of like crypto prop firms outside of Breakout Prop. And yeah, Crypto Fund Trader, I think this is probably the two main ones. So here now you start seeing that there is a difference between one-phase and two-phase challenges. Now, let's start off with the one-phase one, because it's a natural segue from what we've already been discussing in regards to Apex. So if you take a look at the one-phase, like, let's take a look at. And by the way, like, you can kind of like go through. One of the other things that I did not mention when it came to Apex is that you don't necessarily want to go for just the biggest account that you can get, because, like, just to give you an example, if we take a look at a 150K account here, your max drawdown is only 4K, right? With the 50K, you have 2K. Well, that doesn't quite add up, right? The account size is 3 times of the 50K, but your drawdown limit is only double. So it depends on what kind of goal that you're going for. Essentially, like, with the 150K account, the profit target is still 6%, but the drawdown limit is like 2.5%, which can be a little bit rough compared to the 50K, which also the reason why, like, you see a lot of people who use Apex, even though they have a lot of experience in trading and they have, a lot of capital at their disposal, they'll still go for the 50K account and they'll just get 20 accounts, which Apex, by the way, gives you a maximum of 20 accounts. That's why I say 20. So instead of like going for 20 150K accounts, where it's really easy to potentially blow this, like, they go for 50, because your drawdown limit is 4%, right? Which is acceptable. Is it the best? No, but for one-phase challenges, it's acceptable. It's industry standard. So that's just something to keep in mind. So in regards to all of these accounts, their pricing is not going to also reflect the amount of value that there is as well. So for example, with Apex, like this is too cheap to even talk about, but let's go into, crypto fund trader. Now, most other prop firms outside of Apex, I think, will just have a set number. So depending on the account that you go for, like nothing's really going to change. And obviously the bigger the account that you go for, the better value for money that you're going to get. But there's also a caveat, right? You kind of do this do this calculation by yourself. For example, the one phase 10K account compared to the one phase 25K account, like there's not that big of a difference between the actual value, right? If you multiply 10K or like 120 by 2.5 times, you're going to get around $260, $270. But if the 25K account is also about $260. If you multiply $120 by 2.5 times, you're going to get $300. But the 25K account, if you were to just, it's $260. So it's a $30 to $40 difference, right? It's not huge when you're dealing with the smaller numbers. 25 to 50, that's when, it becomes meaningful, because instead of $530, you're looking at $450, and that's before the discount, right? Again, most of these prop firms will do discounts, and in this case, you have a 23% off. So you kind of do the math. From 50 to 100, that's 900, you're saving $100, right? And then from this to that, like you can do the math. I'm not going to talk too much about this, but just to go back to what we were talking about before, maximum daily loss. So the difference between, the Apex kind of like one phase challenge versus a more legit one phase challenge, if we can put it that way, is that, we have 6% maximum loss and we have a 10% profit target, right? So it's going to take a little bit more time to pass, but at the same time, it's going to be less likely that you're going to blow the account up. But again, when it comes to one phase challenges, you're not looking to hold the account for like months and months and anyways. So pick the one that makes sense. But one of the things that we should talk about though is a trailing loss versus, if you take a look here, in fact, this is not even going to be the clearest one. So let me go into funding pips to show you what I mean when I talk about trading loss versus a static drawdown. So if you take a look here, all right, let's take a look at funding pips, right? Let's take a look at the two-step account. In this case, you have a maximum loss, but the moment you click this question mark, it says that it's 10% of the initial account size, which means that if you have a 100K account, the account cannot go below $90,000 at any moment, right? That is the point where you will blow the account. Now, what's different compared, this is known as a static drawdown, right? Which is what you want to look for when it comes to long-term accounts. But with Crypto Fund Trader, for example, with their one phase account, it says trailing loss, which means that, let's say on paper, right? Let's use a $100,000 account as an example. Let's say that you have now hit $106,000 on the account, right? You're 6% up. That means that at this point, your stop loss, right? Point at which your account is blown is no longer 94,000 as it was at the start. It is now 100K, right? 6% from where you currently are. 6% away from the highest point that you've reached within the account. That is what the definition of a trailing stop loss is. When it comes to one phase challenges, that is perfectly fine, right? Apex works the same way because it's a one phase challenge. But for two phase challenge, you want to go for a static drawdown. So for example, here it says maximum overall loss. That means that this is a static drawdown. It means that if you get a 100K account, as long as you don't go below 90K, you're going to be good. So even if you're at $105,000, at that point, the point that you would blow the account is if you go from 105 to 90. So that is still perfectly acceptable. Now that we're getting into two-phase challenge, you know what? Let's talk real quick about just the one-phase challenge. Let's take a look here. All right, so with a one-phase challenge, as you can see again, minimum days traded, you need at least 5. And then maximum days traded indefinite means that you do not have a time limit. It's a one-time fee and the account is not going to expire as long as you do not blow the account up. Lastly, leverage. This is automatically baked in. For example, especially if you use a platform like MetaTrader 5, then leverage tends to be baked in directly. You don't have to like select your leverage as you do when it comes to a crypto centralized exchange. And so over here, this is just to pass the account, right? Once you get into the live stage, you'll get an 80% profit split, which means that, okay, let's say I make $10,000 on for this month and I want to withdraw my profits. So instead of getting 10K, I'm going to get $8,000 because that's the profit split. Now, when you start, adding this to cart, which I'm going to try now, they will give you the option of, let's take a look here. Right. See, they'll give you the option of adding payouts. They'll give you options to add, kind of like extras. Now, you don't need this. Again, 90-10, great for a two-phase account where you're planning to get serious on. Absolutely amazing. Weekly payouts, chances are you're not going to need this. You're not going to need a payout every single week. It's perfectly fine to wait, a couple weeks, 3 weeks, 1 month, which is another thing that you should definitely read about when it comes to the prop firm rules, which is like, what is the payout frequency? Some allow you monthly payouts, some do daily payouts, some do weekly payouts. They're all going to be a little bit different. Now, 0 days minimum traded, like, it doesn't take a genius to understand that this is not necessarily needed. Right? Chances are you're going to do things the proper way anyways, and you're not going to be looking to pass the account in a single day, right? That's why I say when you get to the checkout page, there will be add-on options for you, and chances are you're not going to need them until, quite later down the stage. Now let's take a look at two-phase challenges. In the two-phase challenge, essentially, instead of passing, like for example, when you pass phase 1, it doesn't mean that you are now funded. It means that now you've gone into phase 2 and you kind of repeat, like you've got to repeat everything again. So in phase 1, like again, your maximum static drawdown is 10%. You cannot lose more than 5% in a single day, which means that theoretically speaking, you could risk 5% of the account in a single trade and you'll still be fine, right? Obviously, don't keep it at 5%, maybe do 4.5, right? In case, slippage or whatever, then, if you risk 5%, you might go over. But still, ideally, you're not doing this, of course. But still, your profit target in this case is 8%, which means once you hit the profit target, you don't hit your stop loss limit. All right, now you move into phase 2, where you have to trade another 5 days and you have to hit 5%. But when you get into phase 2, your account's going to get reset. Essentially, you're going to be at $108,000 and it's going to get reset. And then boom, it's back to 100K. Now you get to hit 105 without blowing out the stop loss. And then boom, now you're at a live stage. Now, the beautiful thing about a two-phase challenge is that yes, it takes longer to pass, but at the same time, because you have a static drawdown limit, means that you're very unlikely to blow this account up, which is why I would only recommend getting into two-phase challenges, not at the start where you have, you have to be like, budget conscious. It's like, oh, I only have $100 to spare. Let me get a 10K two-phase challenge. It's an absolute waste of your time. Even once you pass it, it's like, oh, you've got 10K. Maybe you make a few $100 from this. Why not put that money into one phase challenges, pass it, get a payout, and then like, let's say you get a $1,000 payout, maybe you buy two 50K, two phase challenges. And once you pass those, oh man, 50K is the point where it starts to feel a bit meaningful because, if you get 5% in a month, you get 2.5K. And that for most people is an okay, like it's good money, right? It's not amazing money, but it's enough to pay the bills at the very least, or pay rent or a portion of rent, depending on what kind of house you're living in. But still, you get the idea. And then lastly, we get into the instant funding. This is honestly still a very new thing in regards to, the prop firm kind of industry. So I personally have not tried this out yet. And then lastly, you're going to see the instant funding, which, in funding pips, if we come here, it's kind of known as the zero. Essentially, you don't need to pass a challenge. In this case, you pay the money and you're basically straight into the live stage. The thing is, A, it's going to cost a lot more money. B, you will have much tighter kind of like maximum loss limits. And 3, potentially your profit share is going to be a lot less as well compared to a proper one phase or two phase challenge, which is that the end of the world? No. It depends on the goal, right? Different types of accounts will be suitable for different people who are looking to accomplish different goals. But when it comes to the 0-step challenge, I would honestly recommend going for the 1-step just to start, because like with the as far as the 0-step challenge, oh wow, whoa, funding pips is absolutely amazing actually. Look at the 0-step challenge. It's a 5% drawdown limit, which if 1-step, it's only 6%. It's only $20, less expensive. It's only $20 less. Your drawdown limit is basically 1% away. And take a look at funding pips. And by the way, funding pips is one of the more reputable prop firms out there that I would definitely recommend. So this is alongside FTMO, alongside Fibers. In fact, let's go take a look at FTMO. And in fact, let's go also take a look at Fibers. These are all kind of like really good ones. And then last one is FundNX. So basically FundNX, Apex, and Funding Pips are kind of like 3 of the more kind of like transparent prop firms out there, in the sense that they don't really have that bad, like they have really good reputations, and especially like they have really good payout transparency. So you're almost never going to get fucked over by them. In fact, every single prop firm that you see on my screen right now, you're basically going to have very little you're going to have very little chances where you're going to get screwed over by them for some bullshit reason. But still, let's go talk about them real quick. Now, when it comes to FundNX, let's take a look here. At this point, you should already kind of like understand what is going on. There's 1-step, there's 2-step, right? And you can just kind of compare and contrast between the both. The profit target of FundNX is the same as CFT in regards to the 2-step challenge, where it's 8% and then 10%. Maximum drawdown limit is 10% as well. And like most of this is the same. So the only difference, I think, is that, with FundNX, which is, by the way, very legit, they have a 15% performance reward. Basically, if you manage to pass the challenge and once you get a couple of payouts, they're going to give you like a little bit bonus on top of that. I know the wording is really misleading. It kind of makes you feel that, oh, if you pass the challenge, you're going to get $300 back. But in reality, that's not how it works. They only give you this as a bonus once you get 2 payouts. So definitely just click on this, and always click on this, because like the wording that they have on their website can be a little vague sometimes, and they make it like that on purpose because like most people won't care to read. And also, like, if they can kind of like manage to scam your money, and fantastic. As long as you become a customer and they make money, that's kind of what they're looking for. And obviously, even a reputable one will do this. Not a big concern. But yeah. Oh, another thing that you should definitely look about is another thing that you should definitely look into when it comes to different prop firms. Most of these you'll find within their rules. For example, I will come into FundNX rules or FTMO rules. And you definitely want to take a look at news trading just because of how big of a part news trading is within the AOC system, where we're looking to primarily take most of our trades when we're within the news window, which is an hour before news to the hour after news. Now, some prop firms out there, not every, will, for example, if you take a look here, if you happen to take a trade 5 minutes before and after high impact news, only 40% of the profit is counted for these trades. FundNX is already amazing because some of these where 5 minutes before, 5 minutes after, they will completely disregard any trade that you end up taking, which is pretty rare nowadays, to be honest. But still, like with FundNX, this is perfectly fair. And of course, click here to learn more. Like like just go into the specifics, right? You don't want to be caught by surprise and then you end up blaming the prop firm. As reputable as they may be, just take some time to respect their rules and to just at least find out. For example, you might think, oh, what if I have a trade taken an hour before news, but then once news happens, 1 minute after news, my profit target hits. So let's take a look. Well, this applies to both market open or market closing, or if you end up having a take profit or a stop loss that gets hit during that period, it's only going to count for 40%. In this case, you might think, okay, FundNX might not be the best option for me based on this list of available profits because I will most likely be trading a lot of news. So in this case, all right, let's move on as an example. But anyways, just taking a look at the Stellar one step, pretty much the same. Stellar Light, and then you have your instant funding, which might not actually be a terrible idea, considering that you're essentially paying 100. You're going to be paying a little bit of a premium, right, compared to the two-step challenge. Let's see here. For a 5K account, you're going to pay $150. For $150, like you could get realistically a 15K account, right? So you're basically paying 3 times the amount to basically skip the entire funding process, which isn't worth it. As a beginner, I don't think so. But if you're experienced enough in this game to where you already know what you're doing, are 100% clear that you have an edge and you're profitable, then yeah, this might be worth it because like at that point, more money equals more capital equals more money made. But anyways, at this point, you should also understand the difference between, for example, in their one-step challenge, I think this is a static drawdown. But again, just read this. Yeah, okay. So in this case, because it's a maximum draw loss limit and not a trailing loss limit, this is a static drawdown, which for a one-step challenge, again, is a bit misleading because you're not looking for your one-step challenge to give you, like obviously you will look for multiple payouts with a one-step challenge, but still you are generally going to be a little bit more aggressive on the one-step challenge. So is this the end of the world? No. Is this something that will make you consider, this firm over that firm as a main reason? No, because it's a one-step challenge. Now on the two-step challenge, absolutely, right? You basically don't get any two-step challenges that are trading drawdowns. For one step, does not quite matter. So now you know how to read that. Now let's go into fivers, right? Now, when it comes to fivers, you have basically, they have a 3-step one, which is actually the thing that kind of got them famous because the 3-step challenge is something that you can get into for very low cost. For example, here for $95, you can pick up a 100K valuation basically. Now I know, Apex, you can get it for much cheaper, but this is actually a proper account in a sense that, oh no, they've changed it. All right, over the years, they've changed it. It used to be like a 10% maximum drawdown limit, but still, like 3-step challenges, ideally, you're going to want to avoid the 3-step challenges because based on what I've explained to you in the past from before, the more time that you're spending, grinding away at prop firm challenges is the more time that you're going to be spending trading without getting any sort of payout from it. So when it comes to prop firm challenges, ideally, you don't want to go more than 2-step as a long-term account. And in this case, this would be, all right, maximum loss, 10%, pretty standard so far. Now, if you take a look here, once you're actually funded, or fivers, they're one of the ones that are known to allow you to scale over time. So for example, every 10% that you make on the live funded account, you're going to be eligible for scaling where, the value of your account is going to increase. Now, and then one step, this is probably going to be some sort of a, the stop out level. This is Fivers is known to be one of the most reputable prop firms out there in the space, and even their language is a little bit ambiguous. So definitely read into what exactly this is. At this point, you should understand what this is. So next up, let's go into FTMO, and this is probably going to be the last one. So FTMO, hopefully at this point you're very familiar with the language of prop firms. So FTMO right now, what we're looking at is the two-step challenge. And in this case, you have a maximum daily loss of 10%, minimum trading days for 4 days. Rewards, in FTMO's case, they give you 90%, which is a lot better than a CFT, because just to give you an idea, if you happen to have a 100K account and you make 10K, 10%, the difference of 10% is literally, $10,000. Sorry, difference of 10% is literally $1,000, which is it meaningful for most of you? I would assume yes, but just getting back into it, maximum daily loss, okay, fair enough. And in terms of the refund, this is also another thing that you can look out for, which is a lot of the competitive prop firms or like the proper prop firms out there, they will often offer you some sort of a refund for passing the challenge. In FTMO's case, whatever money that you spend on the account, for example, let's say I spend €1,000 on the 200K account, once I pass the challenge, right? If I don't blow the account up, if I pass the challenge, I get back the €1,000 that I put into the account. So essentially, your downside risk becomes nothing because that's just how prop firms work, right? Magical. Just moving on to the one-step challenge, take a look. And in this case, like, yeah, for the most part, it's exactly the same. Now, one of the other things that you will kind of see is with prop firms, some prop firms, case in point, like we've only now seen it on FTMO, is known as a consistency rule, or in FTMO, they call it a best day rule. Essentially, your most profitable day, which means must not account for more than your 50% of your positive day's profit. Essentially what this means is that, let's say my average win is $500. Now, if I happen to get a trade that is like a $5,000 winner, like that trade is probably not going to be eligible for some sort of payout, because in that case, like I might have just got lucky on that trade, or especially when it comes to, passing a challenge, I can't just, win 3 $250 trades and then win one 3K one and then I'll pass it, right? Not every prop firm does this, but FTMO is probably one of the most reputable ones out there, and they do things properly. So in this way, they're just encouraging like, good disciplined trading. Now, a lot of prop firms do not have this rule, so don't be afraid. Like only in the case of FTMO, that is the case. But yeah, in terms of the one-step challenge, you have a 10% profit target. Your maximum loss is 10%. Now, this is actually really competitive. Outside of the price that you pay for the account, which is relatively high for, for most competitive prop firms out there, the actual rules of this one-step challenge is actually quite favorable to you as a trader. So if you're looking for a long-term one-step challenge, FTMO might be the way to go. And it also just so happens that they give you a lot of options in terms of trading pairs, which, by the way, I completely forgot to mention this inside the actual module. But the one very important thing that you should definitely look out for is the trading assets that were allowed to trade when you sign up for that prop firm. For example, with FTMO, go into, for example, it's quite easy to find where with FTMO, they will show you exactly what tickers that you can trade. For example, here you have most of the major crypto pairs, you have most of the major forex pairs, you have most of the major indices where you have Nasdaq, you have the S&P 500, crypto, you even have crypto, right? And then lastly, you have commodities, right? So basically, FTMO is something that covers all grounds, where you have oil, you have gold, you have the futures, you have the indices, you have the forex. That is not the case for something like Apex, for example, where Apex is a futures firm. So with Apex, you're not able to trade forex, like at least not the conventional kind of way of forex. So when it comes to, I just did a quick Google search, by the way, Apex Trader Funding tradable assets. What this tells me is that it specializes in futures prop trading. Now, what that means is that, yes, you're still going to be able to trade currency futures. But for example, when I go onto TradingView right now, usually you would look at Forex as, Euro USD. Well, not in the case of Apex, because in Apex, you would only be allowed to trade this other chart called Euro futures, right? Euro FX futures. Take a look here. We're looking at various FX. Now, if you take a look here, they have a wide variety of futures products across CME, CBOT, New York Next, and CONEX, right? CME, right? Futures from CME. Now, is this a relatively similar chart compared to Euro? Yes, but as you can see here, the Euro futures are currently trading at 1.151, while Euro USD is trading at 1.147. So this is technically, like when you're trading Euro futures, you're technically trading futures, you're not trading Forex, okay? So just understand that small little difference. So if you're looking to specifically trade Forex, you want to make sure that whatever prop firm that you go on, right? Let's take a look at funding pips. For example, now that we take a look at funding pips, you will see that, all right, they allow Forex, they allow gold. And by the way, in terms of Apex Trader Funding, the chart on gold is also different, right? Because you have XAU USD, which is what we traditionally known as gold, and you have GC, which is gold futures, right? Similar, you're going to have a roughly similar chart, but still there are slight differences between the both. So depending on what you're going for, that is also a very key consideration when it comes to whatever prop firm that you're going for. Now, FTMO 5ers, even CFT, Crypto Fund Trader, like as long as you're going for the MetaTrader 5 option, which by the way, if you end up choosing Bybit, it means that you are fully limited to just crypto. So I would highly recommend, unless you're getting this specifically for crypto, I would recommend MetaTrader 5 because at the very least, this still gives you the option of trading Forex pairs and also like indices or futures or just anything in between. So let's take a look at Crypto Fund Trader, trading assets. And yeah, let's take a look here. You have cryptocurrencies, you have Forex, right? When they say Forex and not future, like there's a difference between Forex and currency futures. If it's Forex, you can trade Euro USD, GBP USD, like your traditional Forex pairs. You have commodities, which basically refers to oil and all of that stuff. And you have indices, which refers to NASDAQ, S&P 500, the Nikkei 100, the GER 40 or whatever, and stocks, right? You even have stocks, which means you can trade stuff like Tesla and whatever. Now, with leverage, it is again automatically calculated if you're using a platform like MetaTrader 5. And yeah, that is about it. Not gonna lie, this video has took a lot longer than I expected, but there just ended up being a lot more to cover in regards to prop firms. But hopefully this kind of debunks every question that you could potentially have in regards to prop firms, how to pass it, how to fail it, how to get profits, get payouts, blah, 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 how to navigate this very complex, very, jargony kind of world of prop firms, which by the way, now that I've done this explanation, hopefully you start to see how easy this is. But still, I'm gonna go take a break now, but still, hope you enjoyed this video. Feel free to just shoot me a chat on WhatsApp, on anywhere, if you have any questions regarding this. And I guess the final question that you might have at this point is what prop firm would I recommend? Again, Apex would be the first option if you're just starting out. You can never go wrong with any of the 5 that I've just shown you there though. Just compare and contrast as to what assets you're trading. Use the profit splits and even the budget because they're all going to have different prices, which also tends to reflect the quality of the prop firm. And do not be afraid to experiment with a little bit more, new up and coming kind of like prop firms out there, because chances are you're going to get a lot more competitive rates. Like just some ones that I can think of is, stuff like Tradeify, you have upcomers.com. Of course, I'm, recording this as of the time, in 2026. These are some of the options that you have. You also have stuff like Go to Fund a Trader, like just slightly aggressive ones, slightly up and coming ones. But either way, whatever that you get a good deal on, as long as it's transparent, as long as it has a good reputation for, not scamming people, and as long as like it never hurts, especially once you have TradeSyncer. You're not really losing much time because you're going to be trading anyways. You're just going to buy an account from there and link it to TradeSyncer. If you pass it, great. See how, they approve your passing or not. And if you get a payout, great. See if they approve it or not and see how long it takes for the payout to get into your account. And ultimately, you might just end up, discovering a little bit of a hidden gem, which is always great when it comes to prop firms, because at some point you're going to kind of come to realize that with all of these prop firms, they have a maximum funding rate of, anywhere between $200,000 to maybe $500,000. In the event that one day you become a world-class trader and you would like to get to $10 million in funding, you're not going to be able to achieve it with just the list that I've given you. Chances are you're going to need to experiment with different other prop firms. And yeah, that's one thing and yeah, again, just remember, firms are just a tool. Like when used right, it can achieve some miraculous effects on your trading journey. And when used wrong, you're just going to be continually banging your head against the wall and not really seeing any sort of progress from it. So treat it as it is. It's just a tool. It's just a business transaction. And ultimately, go make some money with prop firms because now you have the tools and all the knowledge. Cheers.